Hello, welcome back. Take a look at this over here. This is the social trends module of our tool here. You will see that currently JP Morgan Chase is actually trending both on StockTwits and Twitter. Very interesting and understandable because the stock has been going down on fears of inflation and the company missing on earnings. Very handy that you can actually click on the stock news here and basically examine what's going on with the company just by the titles here. I love this module. It actually tells you that the company's profits have tanked, they have boosted their credit, and they are seeing significant challenges ahead due to high inflation. The bank took $500 million loss due to Russia and misses on earnings and all that jazz, and kind of tells you a lot about the story of this company and its financials, what's going on right now. But we do want to take a look at the stock analysis chart and see what we can deduce for this company. Now, when we are talking about banks, and I have made dedicated videos about it, you have to be super careful because many people can actually make the mistake of just examining profit and free cash flow. But it doesn't work the same way as it works with a regular company because companies, typical companies, get debt in order to grow their business. But banks are actually handling debt as part of their business. So they're actually handling credit as if it is a product, as if it is a service. And so it's part of their core business, and they can have a lot of debt and yet still very solvent and very fine in terms of their financials. So bear in mind, this is very important. And one of the things that I really like examining when we're taking a look at banks is the price to book ratio. This is what tells me a lot about whether a company of that sort is worthwhile buying, because price to book actually tells me what is the current price of the stock compared to what assets the company is having. And again, a company that's actually utilizing a lot of credit, what we do want to see is that they have good assets when we compare them to the stock price. And also return on equity could be an interesting one because return on equity actually counts debt as well as part of this calculation here. So this is another interesting number. But other than that, all these numbers like the debt to equity ratio, or for instance the price to free cash flow, or the PE ratio here, which are incidentally fine here, can be massively skewed again because of the credit that the company is actually reserving here. This can really skew its operations and its actually key metrics here and still be fine in terms of what they are doing financially. Or this one, look at this, free cash flow to total liabilities is very high. You typically expect it to be like 5 or something, but in this kind of a case, like in a bank, I wouldn't pay attention to that, probably not at all. And as I said, you want to see is this number going down as much as possible. I like buying banks when this number is significantly below 1, to tell you the truth. So if I see a number that's like 0.7, 0.8, 0.5 even, then I really like getting some banks. But banks are risky, especially in a high inflationary environment right now, because when you have high inflation, it's tougher for people to borrow money. And so this really affects banks because banks are basically businesses that are handling debt. They're actually giving loans to people. And so when that happens, a bank may be having issues with remaining profitable and actually making money out of this situation. And this is why typically in a high inflationary environment, I'm not a big fan of holding banks personally. So right now I don't really have a bank in my portfolio, and I'm not looking to get one, to add one to my account, even if it starts going down. So as you see here, the max chart, the company was high for a while, and now it starts going down. People may be thinking, okay, it was, what was it here? It was like 168 over here, and right now it's 127. And actually the 1 year high has been even higher. And so maybe momentarily. But the thing is, you may be seeing this coming down and today being 127 and be like, okay, it's about 30% from its highs. Maybe it's time to buy. And I'd say I wouldn't buy here. I probably wouldn't even buy if it goes down to these levels, which I find that it's possible actually. I wouldn't be surprised at all if it happens in this current environment at least. Because again, high inflation can really hurt banks here, and I'm expecting that banks of that sort, even if they are big banks like JP Morgan Chase, could have some massive downturn here. So this could be an interesting play for the short side really, as a trader. But personally, as an investor, I wouldn't really want to hold this stock right now. Probably not any other bank stock, as I said. And I'm not in my account, as I mentioned earlier. I don't have any banks. So this is something that you really need to take into account, because the environment, that the current environment matters, and this can actually over the long run keep being a good company that's going to be trading much lower, and it could be a nice opportunity. So what I'm going to be doing is actually noting this company down and waiting for it to go down, and if that happens, then I may have an interesting opportunity here for me to enter. Again, I'd like to enter if the actual price to book ratio is maybe 0.7, 0.6, if it goes down significantly, that is. But as it is right now, as you can see the company's stock price right now, I would definitely avoid, regardless of the company's financials and especially the price to book being relatively fine. I think the current environment pressure can cause the company to go astray for a little while. And also the dividend payout ratio is pretty good as well. I forgot to tell you that, it's 3.1%. But again, in the high inflationary environment that we are right now, this is a very tricky play, and I think I would avoid again because of that, and not just because of the company. It is destined, it is bound to face some pressure here, and I'm more than certain, really, to tell you the truth, that this one is going to go down significantly. I think I could be wrong, of course. Anybody could be wrong in the stock market, you never know, but that's what I feel about most of the banks at the moment. So that's what I wanted to talk about. It doesn't really make a lot of sense to take a look at the stock evaluation tool, especially for banks. It can produce weird results. But also, again, I told you why I'm making this video and what I wanted to talk about pretty much. And the discounted cash flow model is not the best model to use for evaluating a bank's stock price. It doesn't fit it that well. You have other means to examine this that is also given by the tool. But it's best to probably, in most cases, avoid the stock evaluation tool completely, because it can really skew your results and deceive you. So that's what I wanted to talk about. Let me know what you think about banks and JP Morgan Chase. Are you thinking that I'm a little bit too cautious here? Do you agree with me? Leave a comment below. Let me know. I'd love to hear your opinion, because right now things are a little bit interesting and weird in the markets, and especially in high inflation. I think it can really hurt banks. So let me know what you think about it. And in the meantime, thank you for watching this video. Remember to like it and subscribe. Very soon I will be able to give you access to this tool, so you may want to stick around, and I'll let you know how to get to it in about a month or so. And take a look at this video that I made a few days ago. It's about Carnival Cruise, an interesting company, a cyclical company that's worth taking a look at and evaluate. Thank you for watching this, and I'll see you soon. Bye-bye.